Welcome back to Top Tech and Trades channel. High inflation is going to stay because the Fed has undeniably nothing can do about it, and people still don't understand this. Although the Fed is claiming that they're fighting inflation, no they're not. They're going to keep adding fuel to the fire. What the Fed is doing right now is adding fuel to the inflation fire. So Fed monetary policy is going to exacerbate the inflation that we're dealing with. After the Nasdaq bubble burst following the terrorist attacks of September 11, the Federal Reserve lowered rates to 1% to encourage the economy. It's still low, and the Fed continues to produce money, but the problem remains. Budget deficits have skyrocketed. Our yearly budget deficit is currently estimated to reach around $3 trillion per year. The only way to finance that is for the Fed to do more QE or quantitative easing. So even though it's talking about shrinking the balance sheet, it's not really going to happen. The balance sheet is going to keep expanding, but not only do we have this huge budget deficit, we have record trade deficits last year. We had the first ever merchandise trade deficit to exceed $1 trillion in a single year. We also set a new peak in the month of December. We have a $100 billion deficit, and these deficits will continue to rise. Consider the price of oil, which is currently between $92 and $93 per barrel, and it's expected to rise much above $100 per barrel this year. The Fed is going to be forced to print even more money. So while it's pretending it's going to take the punch ball away, it's going to continue to spike it, but it's not going to be enough to sustain the asset bubble. So the change in monetary policy is an important shift to prick the bubble in tech stocks and momentum stocks, but it's not big enough to slow down inflation. We're going to have stagflation, we're going to have a weakening economy, rising inflation, and that is very different investment landscape than the one investors have been used to over the past 10 to 20 years. Because manufacturing must make a profit, they will have to pass those additional costs on to their customers. However, because they have to find a new equilibrium, they end up passing on more than the cost. Every time the company raises prices, it does lose some buyers on the margin because we're all sensitive to price. Start raising your prices, you start losing some customers. So what happens in an inflationary environment is businesses keep selling fewer and fewer products at higher and higher prices. Customers that can afford higher prices keep buying, and those who can't, they go without the products. Last year though, businesses didn't raise prices enough. That was the problem. Because you had the federal chairman and all the economists telling everybody not to worry about these rising costs because they said this is all transitory. And so the business owners believed the economists. They absorbed these price hikes in their own cost because they didn't want to just raise their prices. Many of these companies who were duped into a false sense of complacency about what was going on now have a lot of catching up to do. Not only do businesses need to be ahead of the curve for 2022 and start factoring in rising prices, but they also need to make up for the old ground they lost from the previous year. So they have to raise prices a lot, and that's one of the reasons that rather than 2022 CPI number coming down from 7% last year, 2022 is probably going to be higher from around 7% to 10%. Wages are on the rise. The issue is that they aren't rising as quickly as they should. Prices are high and some people are refusing to purchase goods. Car sales are one example. Car prices have risen dramatically, and as a result, car sales have decreased. Real estate market prices went way up, and so fewer people can afford to buy. People are going to buy cheaper stuff or less things, and it's probably already happening. It's just going to happen more as the inflation gets worse. People need to take care of their needs first before they buy their wants. In the case of consumer companies or utilities, you have no choice but still gotta pay your electric bill unless you want to live in the dark. And no matter what, you're still going to buy gas. So these oil companies are still going to make money. Now you know there are a lot of these companies that have products. It's highly competitive. Like look at all these streaming stocks. One of the places people can easily cut back is just look how many streaming services are you gonna buy. Facebook, you don't pay money to have Facebook account. But the problem is, Facebook makes money from the advertisers, and if the advertisers aren't selling as much of their stuff, because the people on Facebook can't afford to buy it, advertisers can't afford to advertise on Facebook anymore. So there's a lot of these businesses that are going to be a lot of trouble when everybody is tightening their belts. There might not have another crash like the 1930s, but that doesn't mean you don't have to worry, because during the 1930s, we were on the gold standard in which we don't have that benefit anymore. The market can still crash as much as it did in the 30s if you measure it in the price of gold. But this time around, it's the dollar that's going to crash. So if you're only assessing the worth of equities in dollars, and the dollar loses a lot of value, the stock market may appear to be rising. If you're 6 feet tall and I give you a 6-inch ruler to measure yourself with, that doesn't mean you're 12 feet tall. I've cut the ruler in half, your height hasn't changed. It's the ruler that's changed. So if the dollar loses a lot of value and then you go and try to price stocks, obviously the price is going to go up when you're measuring stocks with money that's worth less. Gold is an objective measure of value. That ounce of gold doesn't change. The government doesn't print any gold. So if you really want to know what's happening to prices, you need something like gold as an arbiter, so you can look at it through a lens that doesn't change. And if you do that, all of these expensive assets will plummet. Everything is 10 times more expensive in the grocery. Your electric bill is 10 times higher. So if your stock portfolio has doubled, but your cost of living has increased tenfold, your stock portfolio has lost value since its potential to assist offset your cost of living has been reduced. In compared to all the items you want to buy, the genuine value of those equities has fallen. When it comes to investing in the stock market, nobody buys equities because they desire them. People acquire stocks in the hopes of selling them for a profit or receiving dividends and then going out and buying things. It's the item they're going for. Stocks are just a way for you to buy more stuff. But if the cost of the stuff you want is rising faster than the value of the stocks you hold, you're getting poorer, not richer. If you like this video, don't forget to hit the like button and subscribe. This is your Top Tech and Trades channel, and I'll see you in the next one.